Welcome to the Transparent FX Academy. I'm Nick, and I'm a top author in TradingView with over 190k reputation points. In today's video, I will be showing you a simple Forex trading strategy that you can implement and adjust to your own needs. In fact, not only I will show you the strategy, but I will also put few words about risk to reward, risk management, and how to develop a strategy and adjust it to your own needs, as well as obviously going a little bit more in detail on everything that you need to know when it comes to the price action and technical perspective to actually understand the strategy. In fact, I have divided this video in three parts. The first part is the strategy itself. So I will be speaking about the price action rules that you need to know about the strategy, and this obviously helps also in general in the Forex market. I will be speaking a bit about the structure that you need in the strategy, and obviously this will help you in general in the Forex market. I will also speak about Fibonacci and how to use it in the strategy, and how to use Confluence in this strategy. So very simple concepts. We will just be putting them together at the beginning of the video. Then I will be speaking a bit about risk to reward and risk management, which is a key part of any strategy. It's not only for this strategy, this is for any strategy. And then few words on how to develop a strategy in general, if you're looking to expand this one here that I will be speaking about, or to develop a completely new one, and how to adjust the strategy to your own needs if you want to add some tweaks to the strategy that we will be speaking about. So without further ado, let's jump straight into this lesson. Okay, so let's first speak about these four concepts. So price action, structure, Fibonacci, and Confluence. And then we will be putting them together into the actual rules of this strategy. But first, I want to speak about them so that we are on the same page. First of all, when we speak about price action, we're speaking about the natural movement of the market. Now, as you know, we can have three phases in a market. Either we are in an uptrend, in which we are creating a series of higher highs and higher lows. So the market is printing higher highs, and at the same time, we're printing higher lows. Now, this is by definition in uptrend. On the other side, we can be in a horizontal market. So basically we have a range in which we're not creating higher highs and we're not creating lower lows or higher lows. And then we have a market that is in a downtrend in which we're creating a series of lower lows and a series of lower highs. Okay, these are the three different phases in which we can be in the market. Now, it's very important to also define structure. Now, when you have structure in the market, we usually refer to it, especially in this strategy, with previous resistance turn support in the case of an uptrend and previous support turn resistance in the case of a downtrend. What do I mean? Now, you have an impulse to the upside, correction, the market breaks back above. At that point, this level here from which the market started the move to the downside, that is previous resistance, which is now turned support, from which you're supposed to have a rejection to the upside. Exact same concept comes here, where you have previous support, turn resistance, from which you expect the market to provide a rejection to the downside. Now, this is a very key concept when it comes specifically to this strategy. So I want to show you also a live chart before we get to it. For example, what we can clearly see here, let me show you a very clear example of this. For example, here, what we can see is that the market was in a downtrend. We had the impulse, correction, lower low, lower high, rejection to the downside. What we can see is that this is the previous support which the market broke to the downside, and at that point it was turned resistance here. In fact, the market tested this previous support and resistance and rejected it to the downside. Let me find a clear example of the opposite case scenario. So what we can see, for example, here is a perfect example of it. We have a market which is in a very strong uptrend, right? And what we can see is that at this level, we clearly had previous resistance, which the market broke to the upside. At that point, it was turned support here. The market tested its zone and rejected it to the upside. So this is what we refer to as structure. Price action is whether we are creating higher highs or lower lows. So whether we are in an uptrend or a downtrend, okay? Now bear with me because in few minutes, all of this will be very clear inside of the rules of the strategy. I just want to define all the concepts so that we are on the same page. Now, the third thing is Fibonacci. Now, the Fibonacci tool is very important when it comes to measuring movements in the market. Okay, so if you have an impulse, it's important to measure the correction. If you are already getting the continuation, it's very important in measuring potential upside targets. So let's say, for example, you have a very strong impulse to the upside. The market then provides a correction. You want to measure this correction. You will be taking your Fibonacci from the low to the high of the impulse. I will show you this now in a live market. And you have several potential retracement levels, 0.32, 50%, and 0.618, which is the golden ratio, to which most of the times the market will provide a correction to, which is also the reason for which I have it in red, and then the 0.786, which is the last Fibonacci retracement level, to which the market is supposed to provide a correction to before then printing the continuation to the upside. It's also important to measure targets to the upside. In fact, by taking the Fibonacci on the impulse, we can see that we have the minus 27 here and minus 0.618 here, which are the two targets that the market has good probabilities of hitting. The first one would be the minus 0.272 that, as you will see then from the rules of the strategy, is the first upside target. Now, let me give you an example of this. For example, what we can clearly see here, going back to the previous example, we have an impulse to the downside followed by this correction. If we are to take our Fibonacci from the high to the low of this impulse, we can see how the market stopped exactly the 50%, which was at the same level of this previous support and resistance before rejecting to the downside. And the fact that we were at the same level of this previous support and resistance brings me to the last point of the strategy, which is confluence. Now, what do I mean by confluence? Confluence in the market is when you have several structure levels which are lining up at the same zone. So let's say, for example, like in this case, that you have at this level clearly defined previous support turn resistance. You also know that you are in a downtrend, right? Which is an additional confluence that it increases the probabilities for the market to provide more continuation because we already are in a bearish trend. Plus, by taking the Fibonacci from the high to the low of this impulse, you also notice that the 50% retracement is lining up exactly at this previous support and resistance. So you have three confluence layers which are all indicating that there is a good chance for the bearish trend to continue developing. Therefore, there is a good chance for the market from here to get rejected to the downside. If this is not clear so far, I suggest that you rewatch this first part of the video, which explains basically these four concepts, because these four concepts are of key importance to understand this strategy. Price action, when you have higher highs, higher lows, structure, previous support or resistance, resistance turn support, Fibonacci to measure corrections and continuations, and confluence, when you have several indications that the market has a good chance in moving in one specific direction, also all lining up in the same area of price. That is confluence. So now that we have cleared this up, we can speak about the actual rules of this simple Forex trading strategy. Now, the first point, price action. Now, the first point of the strategy is that you need to have a clearly defined trend. Let's speak about this one here because we were already using this move as an example. Now, in this specific situation, okay, when you have a market which is like this, let's use the reply tool. We have a market which is clearly in a downtrend, right? We're creating a series of lower lows and lower highs. So we are clearly, once the market broke below this low, we clearly started a bearish trend. In fact, the last move that we have is the break below a previous low. How do you easily define that you are in a downtrend or an uptrend? Just look left. Look at what was the market doing the last time that you had a move to the opposite side. Now, in this case, the last time that we had a move to the opposite side was for the creation of this low, but this low is now broken to the downside. So there is no doubt that we are on this time frame in a bearish trend. Now, since we are in a bearish trend, there is a good chance that the bearish trend will continue, right? The second point of our strategy, which is structure. Let's identify the structure. Now, the structure in this case is this previous support turn resistance. So the second point of the strategy, after you define the trend, so you look at the market, Are we in an uptrend or a downtrend? Easy, just look left. If we created a move to the upside and broke it to the downside, we're in a bearish trend, like in this case. Second point, identify the structure. Now, the structure in this case is this previous support and resistance. You just have to look at where is the last time that the market went to the opposite side. In this case, the last time that we went to the opposite side was from this low. Now that we have broken below this low, this previous support is turned resistance here. Perfect. Also, the second point is identified. We know that we are in a bearish trend and we know where is the previous support and resistance. Let's go to the third point. The third point of the strategy is Fibonacci. We have to measure potential retracements, right? How do we do that? As we said before, take our Fibonacci from the high to the low of the impulse. Now, this is where we have to identify the last thing, which is Confluence, okay? These 2 points come together because once you have put the Fibonacci, you already have completed the first 3 steps, right? You have identified the bearish trend. In this case, you have identified previous support and resistance. You have already put your Fibonacci. Now you have to identify where the confluence is. Everything goes around the confluence. Where is the confluence? Because that is where you have higher probabilities of having a test and then a rejection. Now the confluence will be where the Fibonacci's line up the best with the structure. Now, in this case, it would be the Fibonacci that is just below the structure in the case of a bearish setup. So you have here the 50%, which is just below this previous support and resistance, indicating that you have very strong confluence of resistance around this zone, right? Meaning that you have a very high chance of the market to hit this area, which is very strong resistance because you're in a bearish trend, you have previous support and resistance, and you have the 50% retracement before then getting rejected to the downside. Now, at this point, according to the rules of the strategies, specifically, we're supposed to have a sell limit at this area, with our stop loss being well placed above the next Fibonacci level, which will be acting again as more resistance. So even if we get a little bit of slippage, the 0.618 in this case, which is the next Fibonacci level, is supposed to stop the market and then create a continuation to the downside for the creation of the downtrend and continuation of the downtrend. Now, when it comes to the take profit, according to the rules of this strategy, it would be the minus 27, so minus 0.272 Fibonacci, which is the first downside target. So what we're aiming for here in this case is a 1 to 3 risk to reward. If you're not familiar with risk to reward, this is a big problem because risk to reward and risk management is one of the most important things in trading. And if you stick to this video, later on, when we move to the second section of the video, we will specifically create a deep dive into risk to reward and risk management. So for now, just focus on the technical side. Later, you will understand what I mean by risk to reward and risk management. So in this case, according to rules of the strategy, the 50% would be here, which would be our confluence zone. And what we expect is for the market to hit the confluence zone with our stop loss well protected above more than 50% of the area that goes in between the 0.618 and 0.786. So your Fibonacci will be always closer to the next Fibonacci level. And you then expect a rejection to the downside. Let's see what the market did. The market went exactly to hit the 50%, triggering the sell limit. And then we had the continuation to the downside in a quite aggressive way. For an intraday, this just happened in 2 hours. Basically, in 2 hours, we had the hit of the confluence where a lot of sell orders were placed, especially from an institutional perspective, because usually confluence zones are where institutions will have their orders, and then a very strong rejection to the downside, completing the pattern for a very nice 1 to 3 risk to reward. Now, I just want to show you also an example of a bullish setup here, because I don't want to speak only about this. I don't only want to speak about the bearish setup. I also want to find a bullish side. Specifically, I want to go back to the one that we had just before, that we were speaking about also when I was speaking about structure, yes, which was basically this one here. I want to speak also about this one, just to go back exactly to the same examples that I had done when I was speaking about the 4 pillars of the strategy. So as we have here, it's a very strong impulse to the upside, right? Now, going back to the rule number 1, which is price action. Are we in an uptrend or a downtrend? Well, it's very clear here that we are in an uptrend. Why we are in an uptrend? Because if we look at the last movement, it was to the downside and the market broke above the high, indicating that this previous resistance is now turned support here. So what we could expect is a retest of previous resistance turned support and then a potential rejection to the upside, right? The second point is identify the structure. The structure, as you already know, is this previous resistance turned support. We have now identified the structure, right? Now we have to move to the third point, which is Fibonacci, and then we have to identify the confluence, right? To fill up all the rules of the strategy. So let's take our Fibonacci. Now, taking our Fibonacci from this low here to this high, what we can see is that in this case, the confluence would be at the first Fibonacci level that is above the structure as usual. Now, in this case, the first Fibonacci above the structure is this 0.382. The structure is here, meaning that the confluence zone in between the 0.32 and the previous resistance turn support would be this one here, meaning that in this case, the buy limit order would be at this 0.32, just above the structure, just above the confluence area. The stop loss, as we said earlier, would be way below the 50%, so closer to the 0.618 in this case. And when it comes to the take profit, sorry, I took my Fibonacci off. When it comes to the take profit would be the minus 27 of the Fibonacci taken on the impulse leg. Now, if we go forward with this and we see how the market behaved in this case, we can see how we tested exactly the confluence area and that we have identified and then rejected to the upside very aggressively, hitting the upside target. Also in this case for almost a 1 to 3 risk to reward, 1 to 2.8. Okay, so the rules of the strategy here is very simple. Identify the trend, identify the structure, place your Fibonacci, identify the confluence area. Once you have the confluence area, you put your risk to reward tool, you know where your buy limit or sell limit are, you know that the stop loss is supposed to be above or below the next Fibonacci level, you know that the target is supposed to be the minus 27 of the Fibonacci taken on the impulse. So very simple trading strategy. Now, let's go a little bit beyond just this strategy and speak about some concepts that are very important in general to develop strategies and for trading in general. Because if you don't know about risk management and risk to reward, then that is a very, very, very bad thing, because risk management and risk to reward are the most important parts of any strategy. Now, speaking first about risk management. Now, in general, risking 1% per trade can be a good thing, but if you're trading in general and developing a strategy, you can decide how much you want to risk per trade. It can be 0.5%, 1%, 2%, 3%. It's a really, really subjective thing, and it depends from the strategy what kind of losing streaks it can have, and that depends on what kind of results you get when you are backtesting and demo trading the strategy. So you already know more or less what are the statistics of the strategy. When it comes to risk to reward, well, risk to reward, you want to have at least a 1 to 2 risk to reward, or even better 1 to 3 risk to reward. Why is that? Because if you have a high risk to reward like 1 to 3, like this strategy usually provides, we have seen that, for example, here we had a 1 to 3 risk to reward. If you're only trading setups that have at least a 1 to 3 risk to reward, you have the possibility to be right only 30% of the time. So every 10 trades, you have the possibility to lose 7 trades and win only 3, and you're still coming ahead. Why is that? Because if you have a 1 to 3 risk to reward, so let's say you are risking $100 or euros or whatever it is per trade, okay? But you have a 1 to 3 risk to reward, meaning that when you're winning, okay, the loss will be minus 100, but the win will be plus 300, right? Because you have a 1 to 3 risk to reward. So yeah, sorry, I'm terrible at drawing with TradingView. So the loss will be 100, the win will be plus 300, which means that if you are losing 7 trades, okay, after a loss of 7 trades, you will be at minus 700, right? But if you won just 3 trades, so a 30% win rate, still, this will be plus 900. So in the end, okay, the result is still a plus 200, okay? So you still manage to come ahead by being right only 30% of the time. So if you're right more than 30%, this number will be exponentially higher. So that is why it's very important to have a good risk to reward, and why all traders often speak about risk to reward and risk management. So this is obviously no matter how much you're actually risking per trade, if it's 0.5% per trade, 1%, 2% of your account or more. Now, I already mentioned the backtesting, demo trading. That is everything that comes when we speak about developing a strategy or adjusting a strategy to your own trading needs and trading personality. In fact, when you are developing a strategy, it's very, very important that you always follow the steps. First, you backtest the strategy over a lot of data, a lot of setups, hundreds of setups, so that you have more or less an idea of the statistics of the strategy, the win rate, drawdown, how many times you're going to have a cluster of winners, clusters of losers, which pairs are working the best on it. And there, by using that data, you can also adjust the strategy. For example, you notice that, just to give an example, you notice that most of the times with this strategy, the market will actually create a big rejection, go almost at the high and then reject to the downside. Once you notice that, you can adjust the strategy by putting the stop loss above the high, for example, moving your entry higher. I'm just making random examples here, not speaking about the specific strategy. Just to give you an idea of how, by looking at past data, hundreds of setups, you can identify the patterns that the market usually likes to create and behave according to your new discoveries by adjusting the strategy. That is basically how you develop a strategy from scratch, by having an idea about usual movements of the market and then building everything around it. So the technical rules, the risk management rules, where your stop loss is supposed to be, where your take profit is supposed to be, what kind of risk management you want to use. And speaking about risk management, this is just a very basic risk management strategy, because then there are more advanced risk management strategies, but that maybe is something for another video, because we already covered a lot in this specific video. And I really am happy if you stick to this point of the video. And I really hope you appreciated the effort that I put, because I try to be as clear as possible. If not, you can make any questions that you want in the comments below, and I will try to help you on that. If you enjoyed this video, also make sure you smash that like button and comment below. It really does support the creation of more free education analysis for all of you, because obviously it helps with the YouTube algorithm. And I will see you in my next video.